Pete Andresen with Andresen and Associates, and this is my review of the year of 2024. It was a very interesting year. It was, first of all, take a look at this graph. We had the best two-year performance in the stock market, S&P 500, the growth stocks. The best two-year performance since 1928. The stock market and the S&P 500 completely rocked. The S&P 500 is now dominated. It's about 30% made up of the top 10 stocks, and those are pretty much tech stocks. So it was really a tech boom. NASDAQ was up nicely. Everything else, not so much, and that's the other point. I'm disappointed in our overall portfolio returns because what we had in tech and the S&P 500 did great. There was a lot in healthcare, value stocks, small stocks, international stocks. There was a lot that didn't do so well. It just got by. And the bond market produced the worst, say, 3 years in 90 years. It was the worst bond market in the last 3 years that we've had in 4 years that we've had in 90 years. So you had a real yin-yang deal going. You had bonds, which we rely upon for stability, which were supposed to be a bargain, actually do badly. And then we had, because interest rates went back up, and then we had this. It's astonishing. Now, we'll take it. The money's good. However, we've got to keep looking at this and see whether our diversification is worth maintaining. And there's an argument to be made that our diversification is not worth maintaining. Diversification has not been helpful for the entire last 5 years. I welcome your calls about that. I'd like to know what you think. But my first goal in 2024 was, of course, to keep you rich. In other words, catastrophic loss of the kind that comes up when we have a bubble of some sort is extremely damaging. It can drop a stock market 50 or more percent. For example, look at the tech bubble in 2000. We had a very similar trajectory in the stock market in the last 4 years of the 1990s, very similar to what we're seeing now. There's some arguments legitimately to be made that this is not like the 1990s because these stocks have a lot less physical capital. There's a lot less cable going in, for example. But they also have earnings. Remember the 2000 stock market crash featured a lot of companies that just literally didn't have any earnings yet. Nevertheless, there are some similarities as well. And one of them is that old economy stocks lagged horribly. The bond market lagged horribly. Everything lagged except for the chosen technology, the dot-coms, until they crashed. And when they crashed, the NASDAQ went down about 75%, Amazon went down about 80%. It was a bloodletting. Then we had 2008, and here's what I learned about catastrophic loss. You make a great deal of your profit when you buy at good valuations. Right now, things are overvalued. When you buy correctly, it's very hard to get back down to that level where you started. When you buy in and things are overvalued, you can blow through that. Let me give you an example. Alan Greenspan on December 6th, 1996 said in a speech that featured a review of the entire Federal Reserve central bank history, that's the central bank of the United States, said that some parts of the market had reached a place of irrational exuberance. It took 3.25 more years for anything to stop booming. And when it stopped booming, it went all the way back down through 1996, like a brick in an outhouse. As I said, NASDAQ down 75%. So it might take a long time, but it gets there. That's happened again and again and again. And That's what it feels like now. I cannot say, boy, I can tell you, I cannot say what's going to happen in 2025. But here's some valuations for you. Take a look at. This is the PE versus the forward decade return. We're just dealing with simple PE here, the simplest of valuation measures. And as you can see, there's a correlation between high PEs in the S&P 500 and lower performance in the next decade. That's a polite term for saying that there's a substantial downturn built into that decade somewhere. So there's that. What am I supposed to do with that? In the 2000 crash, the old economy stocks, the cement companies, the kitty litter companies, they did fine. And likewise, right now, we've got a lot of small stocks, international stocks, and we've got a pretty good chunk of them in our portfolios, which explains why we lagged the S&P 500 with them, because everything was all about tech in 2024. But then we've got that valuation. Here's another one. This is the VL map. This is the value line managerial appreciation potential, median appreciation potential statistic. And what it's showing us, if you look at it, is that we may not be done yet. It's not as overvalued as it was in 2000. So maybe we've got a couple more years to run. But history tells us that when that break happens, it'll go down through the levels at which it began warning us. So I've got that. Or the situation has totally changed. So what about bonds? Here's our bond. This is interest rates. This is the 30-year Treasury interest rate, not bonds. Basically, the interest rate went up, and then the Federal Reserve dropped interest rates, said we've beaten inflation, and then the interest rate went back up, especially after President Trump was reelected, probably expecting rising U.S. deficits or perhaps inflation from tariffs. A rising interest rate usually means a slowing economy. That may not be happening this time, but we should be paying attention if we want to avoid catastrophic loss. The other thing is, take a look at this graph. This is the interest rate cut scenario. What happens after the Federal Reserve cuts interest rates the first time? And normally what happens is all interest rates across the yield curve decline. That means bonds go up. And this time that didn't happen. Interest rates went up. Again, tell me why that happened. I'm curious. It's very unusual. But higher interest rates on the long end usually are not a good indicator. What we also know is that usually, historically, not always I suppose, but historically, when a catastrophic event does occur in the stock market, bonds tend to act as a cushion and go up. So what your bond holding is doing for you, although they are right now having the worst 3 or 4 years in the past 90 years, I mean, it kind of sucks to be a bond right now, they're a tremendous cushion if that valuation question emerges and we have a market decline. So anyway, that explains why you had such a diversified portfolio in 2024. I have to tell you, I am looking to work with other managers, other investment managers, other financial planners, and I have bounced a lot of this off of them. And some of them, the younger they are, the more aggressive they are, because they haven't gone through a catastrophic loss, really. That hasn't happened since 2008. And so I'm wondering if maybe we should work more with those younger, more fearless people. Call me up and let me know. I'm enjoying working with them, though. And finally, I'll leave you with this. This is the Vanguard 10-year expectations. Why do they have such low expectations for growth stocks? The answer is there's a correction, there's a downturn out there somewhere, but most importantly, it's the valuation question again. So I am not making this up. I'm not hallucinating. I keep checking these numbers and kicking myself. As you can see, expectations for returns for the next decade are higher in international small stocks value, the usual suspects, and yet that is not what has happened in the last 5 years. The last 5 years has been all about tech. So, on we go into 2025. I was disappointed in the returns because of those bonds. If you have a trust where I have not rebalanced, that's going to show better gains because there's a larger equity percentage, most of you, than in retirement plans. In retirement plans, you can't take a loss, and that's where catastrophic losses can do the most damage. If you have an IRA or something designed to pay for your life after you stop working. So I've been more conservative, and thus we lag more in retirement plans. At some point, I don't know, I appreciate your comments. At some point, either my expectations will be proven correct or we'll be in a new paradigm, which is why I want to keep working with those younger people. Thank you very much for your patience. Thank you very much for working with me. Thank you very much for enduring me and enduring this. Stay tuned. We're going to make some changes in 2025 to make your life better. Meanwhile, enjoy. We have a very dry winter going on. Some beautiful days out there. Blessings.